Imagine it's 3rd of December 2001. You are a 46-year-old pharmacist living in Buenos Aires, Argentina. You wake before sunrise in a narrow apartment above your family shop, boil water for yerba mate, and count the rent money you set aside in a clean white envelope every Monday. Your wife keeps the household budget in a school notebook. Your daughter needs new shoes for summer, and your savings sit in a bank that advertises stability with cold marble floors and smiling clerks in blue ties. You are not rich, but after 20 years behind the counter, you have built something solid. A little cash in pesos, a dollar account for emergencies, and the quiet pride of a man who believes prudence is a kind of armor. At 8:30, you lift the metal shutter, stack cough syrup and aspirin in the window, and expect the day to proceed as all ordinary days do. One customer, one receipt, one careful decision at a time. If you have ever wondered why some families sleep calmly while entire banking systems shake, stay with me. What you're about to hear is not a theory, it is a pattern. It has happened before, and it always reveals the same hidden rule. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. By noon, the rule changes. The government announces that cash withdrawals from bank accounts will be limited to 250 pesos a week. The word corralito spreads through the city like smoke under a door. It means a little pen, a little enclosure, a little space where you can move but not leave. You close the shop early and join the line outside your bank. Men in suits are shouting. A woman is crying. Somebody pounds the glass with an open hand, as if force alone could turn a promise back into money. That scene, in one form or another, has appeared across countries, decades, and currencies, and each time, one fact becomes painfully clear. The wealthy do not use private vaults mainly because they love secrecy or treasure. They use them because a bank balance is a claim on a system, while a thing inside a vault is a thing you can still touch when the system starts making excuses. And what they keep there may surprise you. Yes, gold, sometimes jewelry. But also foreign cash, old stock certificates, title deeds, family records, backup passports, portable art, and anything else that can preserve choice when choice is suddenly in short supply. The deeper story of economic history is not just about who had the most money, it is about who had the most options when money itself stopped behaving like money. Collapse is not usually a lightning strike. It is more like a frozen lake in late winter. The surface looks calm until the first heavy foot goes through. Before we go further, there is something important to understand. A deposit in a bank and a bundle of banknotes in a vault may both look like wealth on paper, but they are not the same kind of wealth in a crisis. One is an asset inside a chain of promises. The other is an asset outside it. That difference sounds small in good times. In bad times, it is the whole game. Think of a modern financial system as a tall apartment building with bright windows and a strong front desk. Most days it works beautifully. Your salary comes in, your bills go out, your card taps at the grocery store, and all seems effortless. But the building stands only because many people keep trusting each other at once. The depositors trust the banks trust the government trusts future taxes, future growth, or future borrowing. The moment that chain weakens, access becomes more valuable than ownership. You may still be told the apartment is yours, but if the stairs are blocked and the locks are changed, that legal truth does not help much tonight. This is the core mechanism behind private vault behavior. Wealthy families tend to worry less about returns and more about continuity. Continuity means keeping life moving across bad scenarios. They know that in every major monetary shock, there's a scramble for 4 things. First, assets outside the direct reach of frozen bank ledgers. Second, assets recognized across borders like dollars or gold. Third, proof of ownership, because in chaos, paper records matter. And fourth, mobility, because the most valuable possession in a panic is often the ability to choose where to go and what to do next. That is why vaults so often hold dull-looking things. A deed, a will, share certificates, a second passport, cash and a reserve currency, a few gold coins, maybe a family ring that can be sold anywhere. These items are not exciting because they glitter. They are exciting because they shorten the distance between shock and action. A vault, in this sense, is less a treasure chest than a lifeboat locker. It holds the supplies you hope never to use and cannot afford to need without. This brings us directly to the first part of the pattern. When money is being destroyed slowly enough that people keep denying it, the first winners are often not the smartest or the bravest. They are simply the people holding something real, while everyone else is clutching paper that melts in the rain. Germany in 1923 is the most famous example because it shows the mechanism in the raw with no polite language left to hide it. Before the First World War, the German mark had been a respectable currency. By the most fevered stage of the Weimar hyperinflation in November 1923, $1 US was worth 1 trillion marks. A trillion is such a large number that the mind slides off it. It is easier to picture a wheelbarrow full of notes buying less than a newspaper. It is easier to picture menus becoming lies between the first cup of coffee and the second, The tragedy was not abstract. It sat at kitchen tables. The economist and writer George Goodman recorded the memory of Walter Levy, whose father had faithfully paid into an insurance policy from 1903. When it matured after 20 years, the payout bought a single loaf of bread. The Federal Reserve Bank of Richmond recounts the story of Maximilian Bern, an elderly Berliner who withdrew his life savings of 100,000 marks in 1923. In earlier years, that sum could have financed his retirement. At the peak of the collapse, he spent it on a subway ticket, took one last ride through the city, then returned home to starve. There is no cleaner picture of monetary destruction than that. A lifetime of caution turned into a train fare. Ordinary people did what ordinary people always do at first. They tried to continue. They worked, budgeted, hoped, and waited for officials to fix it. Then prices outran habit. According to the Richmond Fed summary, wholesale prices rose more than 40-fold in 1922 and more than 450 million-fold in 1923. PBS Records workers being paid from a truck at 11 in the morning and sprinting to shops before prices rose again. Teachers handed pay to relatives waiting outside schools so someone could spend it immediately. The currency was no longer storing value. It was leaking value by the hour, like water through a cracked bucket. Now here is where it gets interesting. Not everyone suffered equally. PBS notes that as confidence broke, citizens rushed out of marks and into real goods, diamonds, works of art, safe real estate. The Richmond Fed Review says borrowers benefited, exporters benefited, and Germans with access to foreign currency early in the crisis could often live like the rich. Rural families with food to barter were better off than city families with only paper claims. In other words, the winners did not necessarily hold more money. They held things the printing press could not multiply. And this is where private vaults enter the story. In such an environment, a locked box holding gold coins, jewelry, foreign notes, or title papers becomes a shield against the state's power to redefine money. Not perfect, not magical, but better than a bank passbook that now measures decay instead of security. The middle class learned the brutal difference between nominal wealth and real wealth. Nominal wealth means the number printed on the account. Real wealth means what that number can still command in the real world. In Weimar Germany, the bridge between the two collapsed like rotten wood under fresh paint. The surviving families shared no single ideology, but many shared one habit. They escaped paper marks as fast as they could. Some bought property, some held foreign currency, some converted savings into durable goods, even strange ones, because almost anything solid beat a claim on a dying currency. This was not elegant finance. It was survival logic. When a house is burning, nobody argues about furniture style. They look for the exit. Here's something I want you to think about before we go further. If your bank balance still appears on a screen, but the rules say you can only touch a tiny piece of it each week, do you really possess it in the way you thought you did? Drop your answer in the comments. Seriously. Because what happened next in another country, 80 years later, is the part of this story that turns an old historical warning into something uncomfortably modern. Argentina's 2001 and 2002 crisis was not hyperinflation on the Weimar scale. It was something colder and, in some ways, more shocking to a modern middle class. It showed that your money does not have to become worthless, to become useless. It only has to become unreachable. For years, Argentines had lived under a one-to-one peg between the peso and the US dollar. A peg is a fixed link, like tying one boat to another and hoping the currents never disagree. The arrangement helped tame earlier inflation, but it also made the economy rigid. Argentina borrowed heavily, growth stalled, recession dragged on, and depositors began moving money out. By late 2001, the strain was obvious. On 3rd December 2001, the government imposed the corralito. Cash withdrawals were capped at 250 pesos or dollars per week. Electronic payments could continue, in theory, but daily life in Argentina still relied heavily on cash. That meant millions of people were suddenly being told that their own savings could remain theirs only in a technical sense. The public reaction was volcanic. Reuters later described how the freeze hit around $40 billion in deposits, and how riots broke out, ATMs were vandalized, and supermarkets were looted. The broader economic meltdown pushed millions of middle-class Argentines into poverty. This is what ordinary people experienced, not just falling numbers on a graph, but the humiliation of being treated like children, asking permission to use money they had earned. A bank account that once felt like a vault became a waiting room. But here's the detail that matters for our subject. Reuters reported in 2013 that safe deposit boxes in Argentine banks went untouched when the government froze and devalued about $40 billion in savings accounts during the 2001 to 2002 crisis. That one fact explains a generation of behavior. The account ledger could be altered. The physical contents of the box could not, at least not then. So savers adapted. According to Reuters, people withdrew about $8 billion from foreign currency accounts in response to later currency controls. Some hid cash under mattresses or floorboards. Wealthier savers preferred safe deposit boxes. Argentina had about 500,000 of them, roughly one for every 81 residents. Some of the smallest could hold around $200,000 in $100 bills. The largest could hold roughly 3 times that. Notice the pattern. The vault was not mainly for necklaces and watches. It was for dollars, for paper issued by another country because local trust had been broken too many times. Reuters quoted a 45-year-old lawyer in Buenos Aires saying she did not keep her money in bank accounts, especially not dollars. She took them from her safe deposit box when needed. That is not a romantic image of old wealth. It is a highly practical image of learned distrust. Look at what happened next. This habit spread far beyond the very rich. Reuters estimated in 2013 that between $40 and $50 billion were stashed physically inside Argentina, and that Argentines held roughly $160 billion in assets abroad. Those numbers tell a story bigger than one crisis. They show a society where memory itself becomes a financial institution. People stop trusting official stability and begin building private backup systems. The state says, leave your wealth inside the machine. Experience replies, maybe keep some outside the machine. The winners in Argentina were not untouched. Few people are untouched in a national collapse. But those who had access to foreign currency outside ordinary accounts or had assets abroad had choices others did not. They could buy inventory when suppliers demanded cash. They could pay for medicine. They could leave. They could wait without panic. That is what vault contents really purchase in a crisis. Time. Time to think. Time to negotiate. Time to avoid a fire sale. Time to keep your dignity while everyone else is being forced into desperate trades. The metaphor here is simple. During a storm, most people discover that their house key only works if the whole neighborhood still has electricity. The wealthy spend their lives looking for a key that works even in the dark. Now let us move to Cyprus in 2013, because this case stripped away one comforting myth. The myth is that once your money is in a bank, it is sitting there waiting for you like luggage in a locker. In reality, your deposit is part of the bank's structure.